Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Netflix stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 272 billion market cap. They're trading at $6.29 a share, and they have 432 million shares outstanding. Netflix is a video on demand streaming service. It offers original content as well as acquired film and TV shows. They operate in many countries and offer programs in multiple languages. It is the most subscribed video on demand streaming media service with 260 million members in more than 190 countries. They are the 24th most visited website in the world, with 1/4 of their customers in the US, followed by UK and Brazil at around 6%. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked good in 2020, almost $2 billion, a negative in 2021, back to positive in 2022. Then they crushed in 2023, nearly $7 billion of free cash flow. That means their free cash flow grew over 300% from 2022 to 2023. And their margins are amazing. They converted 21% of their revenue into free cash flow. That's right here, their free cash flow margin, 21%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's a little more steady. 2.8 billion in 2020, up to 5.1 billion in 2021. Then pretty steady after that, peaking in 2023 at 5.4 billion. And their margins are pretty solid, 16% net profit margin. That means they converted 16% of their revenue into net profit. Revenue is the sales for the company, and that goes up each year from 25 billion to 34 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 246 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $214 billion. We divide that by 432 million shares. And we get a calculated stock price of 500. They're trading at 629, so they're trading at a 27% premium. It's a sell according to the model. But I'm still holding my Netflix stock. I bought it in January 2022 at 388. I really like the company. I like their business model. So I think in the long term, it's a good buy. It may seem a little pricey right now, but you never know if there's going to be a pullback or not. That's the risk you take when you try to time the market. There are 44 companies in the same industry as Netflix, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend that much in CapEx. Disney spends the most because of their theme parks. That's a big CapEx spend. They have a good debt to equity ratio, 0.7. For every dollar of equity, they have 70 cents of debt. They do not pay a dividend. They generate lots of free cash flow, second to Disney. I picked up a bunch of Disney in August 2023 to 86 bucks a share. And I'm really happy with that investment because I think Disney is a great long-term hold, just like this stock. Netflix is number 1 in their industry, Disney number 2. Everybody else after that is pretty distant. They look pretty overvalued according to their price multiples. But that's just how these companies trade. They trade at 50 times earnings. Disney, 71 times earnings. Netflix generates a lot of revenue. Look at Disney, 2.5 times Netflix's revenue. Warner Brothers Discovery is more than Netflix at 41 billion. Discovery merged with Warner Brothers. Warner Brothers was part of AT&T. AT&T spun off Warner Brothers in a reverse Morris trust. Netflix is still growing. Their 5-year annual revenue growth rate is 16%. Roku is number 1 at 36%. If you put $10,000 into this company 10 years ago, you'd be really happy today at $116,000. That's a 1,000% return, a 28% annual return. It would have been a bumpy ride. You would have had a really nice run up right before COVID, then a big crash. But hopefully you still held because it came right back up. And I think it's going to go well past this point. Netflix has done 2 stock splits, a 2-for-1 in 2004, a 7-for-1 in 2015. They might be due for another one because the stock price is getting kind of high. Let's take a look at their 10K. We'll start with their income statement. This is for 2021, 2022, and 2023. You can see a nice revenue growth, 30 billion to 32 billion to 34 billion. Let's get a breakdown of the revenue. They only give one breakdown. Revenue from streaming services, 33.6 billion. DVD revenue, yes, they still have DVD revenue, 83 million. They mention right here in April 2023, they announced plans to discontinue DVD by mail service. I thought they discontinued that like 8-9 years ago. They have nice operating margin, 21%. That means they convert 21% of their revenue into operating profit. They added 18 million members in 2021, 9 million in 2022, and almost 30 million in 2023. Their paid members went from 222 million to 260 million. Really nice growth. And the average monthly revenue per member is pretty flat, around $11.60. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue. That's 19.7 billion. Their cost of revenue is 58% of their revenue. It was 61% in 2022, but they improved that back down to 58%. It was also 58% in 2021. The main cost of revenue is the amortization of content assets because they have to amortize their content. Content is intangible. You amortize intangibles, you depreciate fixed assets. Fixed assets are tangible, like a building or a vehicle. Expenses directly associated with the acquisition, licensing, and production of content, such as payroll, stock-based compensation, facilities. Also the cost with obtaining rights to music included in our content. Overall deals with talent. Netflix has built their own global content delivery network. That's the only way they can stream so much content. At any given time, there are thousands, maybe millions of people streaming their content. Including the cost of revenue is equipment cost related to OpenConnect, payroll and related expenses, cloud computing costs that's associated with delivering content over the internet. Other costs include customer service, payment processing fees, like those pesky credit card fees. Below cost of revenue is marketing, that's 3 billion, technology 3 billion, G&A 2 billion, operating income 7 billion. That's up quite a bit from prior years. The interest they pay in their debt, 700 million. That's a little lower than 2022, a bit lower than 2021. 6 billion of income before taxes, 800 million of taxes. Net income 5.4 billion, up from prior years. Earnings per share 12.25. Last year was 10.10, before that 11.55. They did decrease their shares outstanding from 2022. It's 445 million. Now it's 442 million. Let's take a look at their balance sheet. Current assets of 10 billion, current liabilities of 9 billion, so their current ratio is above 1. They have 7 billion of cash. Most of that is cash, 6 billion, 900 million of money market funds, 200 million of time deposits. Time deposits are like CDs. They define it right here. The majority of our company time deposits are international deposits that mature within 1 year. Total assets 49 billion. The biggest asset by far is content, 32 billion. That gets amortized. 13 billion of their content is licensed, which means they buy it from the creator. In order to show the Seinfeld episodes on Netflix, they have to pay the creator of Seinfeld, Jerry Seinfeld and Larry David. That's licensed content, but they make their own content now. That's more, that's 19 billion. They're getting into the content game. That's what I really liked about Disney streaming, is because they have so much content they own already. The biggest expense from Netflix is buying all that content. It's very, very expensive, as you can see here. It's really expensive to create it as well. 28 billion of liabilities. Their biggest liability is long-term debt, 14 billion. Assets minus liabilities equals equity, 21 billion of equity. They raised 5 billion from selling their business. They bought back nearly 7 billion of their own stock. Treasury stock is a contra equity account. It brings down your equity balance, that's why it's negative. And they profited 23 billion from running their business. Retained earnings is a sum of all their prior net incomes. Let's look at the statement of cash flows. The first section is operating cash flow. They generated 7 billion of operating cash flow in 2023, up a lot from prior years. The way you calculate operating cash flow, you start with your net income, that's 5.4 billion. They spent $12.6 billion of acquiring content. They amortized $14 billion of content on their income statement. That's a non-cash expense, so we add it back here. They acquired so much content in 2021 and 2022. That's why their operating income wasn't that high. But they're acquiring less content and making their own, which is why they're a beast and you should buy the stock. In their investing section, they spent $350 million of PP&E, property, plant, and equipment. In their financing section, we could see how much stock they bought back. They bought back $6 billion in 2023. They had a lot of extra cash and the stock was getting low. They didn't buy back any last year. They bought back $600 million in 2021. They also issued $170 million of common stock. This is probably from options and convertible debt. So in their financing section, they had a cash outflow of $6 billion. Let's take a look at the company on Simply Wall Street. Its last price, $628, $270 billion market cap, up 4% in the past week, up a huge 91% in the past year. Let's see what they say about the company. Netflix provides entertainment services. It offers TV series, documentaries, feature films, and games across various genres and languages. The company also provides members the ability to receive streaming content through a host of internet-connected devices, including TVs, digital video players, TV set-top boxes, and mobile devices. It has operations in 190 countries, incorporated in 1997, 27 years ago, headquartered in Los Gatos, California. Here's a stock price since 2002, and it's really hard to tell on this chart. It did take a dip in 2012. I was actually thinking of buying it, but I didn't pull the trigger. Then it had a massive run up close to $700. That was at the end of 2021. I bought the stock in January 2022 at $388, and after 4 months I was down 50%. I will admit I was a little concerned, but now I'm up 60%, so I'm pretty happy. I wish I kept buying on the way down, but you can't buy forever. You just run out of money at some point. Simply Wall Street has them valued at $605. They say they're 4% overvalued. 42 analysts priced this stock at $593. They also say it's overvalued. Their revenue target for 2024 is $38.5 billion, 2025 $43 billion, 2026 $48 billion. Their free cash flow target for 2024 is $6.2 billion, 2025 $8 billion, 2026 almost $10 billion. They had very little debt in 2013. Then they started adding debt in 2015, added some more in 2017, 18, 19, 20. It peaked at $16 billion in 2020. It's come down a little. It's $14.5 billion currently. But when you look at their equity is higher than their debt. For a while, their debt was higher because it was really expensive acquiring content. But now that they built up their balance sheet, it looks pretty impressive. And this green line is their cash. It looks like they do keep a good amount of cash on their balance sheet. $7 billion. That's about half the amount of debt they have. The CEO's salary in 2017 was $1 million. It's gone up quite a bit. Now it's $20 million. Sheesh, that's a nice salary. Total compensation, $50 million. This guy's paid really well. His tenure as CEO is nearly 4 years. 83% of the company is held by institutions, 16% by the general public, and under 1% by insiders. The biggest shareholder is Vanguard at 8.4%, BlackRock at 7%, the big LA company Capital Research 6.4%, Fidelity 5%, State Street, T. Rowe Price, Geode. Then you have a bunch of other companies, JP Morgan, Bailey Gifford, Fisher Asset, Alliance Bernstein, Wellington, UBS, BNY Mellon, Eaton Vance. They employ lots of people. It was only 2,200 in 2013. It's up to 13,000 currently. And the ticker trades in lots of places. The Nasdaq, Zeta, Deutsche Börse, Mexican Bolsa, Swiss, London Stock Exchange, Borsa Italiana, Wiener Börse, Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Sao Paulo Bolsa, Buenos Aires, and the NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.